Hi, welcome back to AIA Uncut. Gold and silver just experienced one of the most violent financial dislocations we've seen in years. We aren't talking about a standard correction here. We're talking about a historic wipeout. In a roughly 90-minute window, an estimated $1.7 trillion in combined market value evaporated from the precious metal sector. The move was fast, aggressive, and mechanical. By the time most retail traders realized what was happening, the prices were already deep in the red. Silver took the brunt of the damage. After trading near the $110 mark, it was hammered down toward the 103 region. Gold followed immediately, plummeting from above 5,100 to just under 5,000 in the exact same window. But if you clicked on this video because you're worried the bull market is over, don't click away. Because the crash isn't the most important part of this story. The recovery is. Silver had rebounded to reclaim 110. Let's be clear, that kind of violent snapback doesn't happen when market confidence is genuinely breaking. It doesn't happen when a long-term trend is reversing. If this were a fundamental collapse, buyers would have stayed on the sidelines. So what actually happened? There was no sudden collapse in industrial demand. There was no macroeconomic shock, no surprise inflation data. The long-term case for gold and silver didn't change by a single percentage point. Instead, the market hit a structural pressure point. This wasn't about sentiment, it was about the plumbing of the financial system cracking under pressure. To understand this move, we have to look at the CME group. A key factor here appears to be a recent change in margin rules. Initial margin requirements for silver futures were hiked to roughly $25,000 to $32,500 per contract. Crucially, the exchange has shifted toward percentage-based margin rules. Here's why that matters. Under these rules, when volatility rises, your margin requirement automatically increases. So picture the scenario. Prices start to slip naturally. Suddenly, margin requirements spike. For leveraged traders, especially the smaller participants, this creates instant financial stress. They aren't selling because they want to. They're selling because the computer is telling them they have to. This triggers a liquidation cascade. Forced selling triggers stop losses. Those stops trigger high-frequency algorithms. Liquidity evaporates, and the price accelerates downward. It wasn't a market decision, it was a domino effect. The rebound tells us the other half of the story. Once the forced liquidation ran its course, and the over-leveraged players were washed out, the real money stepped back in immediately. The symmetry of the recovery proves that the underlying demand never disappeared. In simple terms, gold and silver didn't collapse because the story changed. They sold off because the plumbing broke for a moment. This move says far more about dangerous leverage and crowded positioning than it does about the actual value of the metals. For anyone watching this market, treat this as a reminder. Even safe havens are not immune to mechanical crashes when leverage builds up in the system. The volatility is likely here to stay, but so is the demand. If you want to understand the mechanics behind the market moves, not just the headlines, make sure to like this video. It helps the algorithm get this info to more traders. Subscribe to AIA Uncut and turn on notifications so you don't get shaken out by the next big move. We'll see you in the next episode.